Welcome back to the Brent Bruce Daily, where each day we take a look and see where home loan interest rates really are, what is making the move, and what to expect for the future. Today is June the 8th, 2023. It is now 2:52 p.m. Central Time. I have not been able to get my report out for a couple of days. I've been having some technical issues with my recording software, so I have a lot to go over with you. Over the last few days, we've seen home loan interest rates increase to nearly the highest point we've seen this year, even touching into the sevens on the Brent Bruce Daily, which, as you know, doesn't happen very often. And when it does, it bounces back very quickly, which is what we're seeing today. Now, really, the fly in the ointment that we've been experiencing this year has been employment. We're seeing employment too strong for the Federal Reserve. They want to see employment get hit harder. They want to see more people lose their jobs. They want to see more people looking for jobs. They want to see more layoffs because that would show signs of the economy basically feeling pain. And you could remember if you watch this video, this report often that there was a moment where the Federal Reserve actually said they want to cause pain to our economy in order to get inflation under control. That is how important it is to get inflation under control. So, increasing the federal funds rate has effects that usually cause layoffs in the overall economy. Now, I see layoffs almost every day, maybe every other day, on the different reports that come out from a lot of the large employers, but yet the Bureau of Labor Statistics continue to put out very strong numbers as far as employment, positive numbers showing huge job gains, which just doesn't seem to make sense. And again, we talked about that the household survey, where they're actually calling people and asking them their employment situation, shows tremendous job losses. But somehow the Bureau of Labor Statistics continues to show gains on their reports, which we've basically said this is very suspect for quite a while. But the Federal Reserve and a lot of the people who are involved in the markets and trading look to the reports to be the end all be all. So we're seeing things showing it, overall showing as though inflation is not coming down strong enough, and that is rolling over to the effects of the Federal Reserve and to the bond market and mortgage-backed securities. So we're going to take a look at that here in just a minute. Now, interestingly enough, as we talk about that topic, I thought this was kind of interesting. Here is a report that came out earlier today. Jobless claims increase more than expected to their highest since October of 2021. This is saying jobless claims. People that don't have a job are at their highest since 2021. However, take a look here at the front page of CNBC. Now, that report that we just saw was the very front right here this morning early. Now, so that is showing a negative jobs number was on the front page of CNBC. At this point here, now just a few hours later, you can't even find that report. It is completely gone from the front page of CNBC. Now, when you have a strong number from the Bureau of Labor Statistics, it's up there front and center throughout the whole day. Interesting how that happens sometimes. So let's go over and take a look at how the markets feel about things right now. We're currently up 38 basis points. That is because the markets, the bond market saw this report. I saw when the numbers started going up when this report came out showing jobless claims were increasing. That is going to be another factor as to what the Federal Reserve is going to be thinking about next week. Remember, next week, we're getting the consumer price index, we're getting the producer price index, and we're getting the 2-day meeting from the Federal Reserve where we're going to hear if they're going to increase or leave alone or decrease the federal funds rate. Now, most people are saying that they expect the Fed to pause on the federal funds rate increases, which would be tremendously helpful. They're not going to say, hey, we're done, but they're going to say, we're pausing. It's interesting how these words matter. They're not going to say, we are done increasing the federal funds rate. They're going to say, we're on a pause, which allows them to come back and increase the federal funds rate later if they want to without going against their word, so to speak. And I think that this is going to be the last increase to the federal funds rate. I think we're going to see it start to come down probably in 2024. And the report that we just looked at here a moment ago, jobless claims increasing more than expected, is going to help the Fed. Another reason that the Fed will go ahead and pause on the increases to the federal funds rate. Let's take a look at what the market is thinking. Again, up 38, now 39 basis points, a very good day for mortgage-backed securities for home loan interest rates after seeing that report come out with jobless claims. The 10-year Treasury is down 9. I'll take it. Pretty good day. Go over here and look at the charts. You can see that we've been really battling and dancing back and forth with this Fibonacci level at 99.845. We want to stay above it and start to fight with some of these moving averages here to start to see some real improvement. But again, I think we're really going to see the fireworks next week when we hear from the PPI, the CPI, and the results from the Federal Reserve announcement, which I think are going to be all good news. Let's take a look and see what that means as far as our home loan interest rates. We're going to pull up the Brent Bruce Daily scenario here, which is our very well qualified 30-year fixed conventional home loan, 800 FICO score, 25% down. We are at 6.875. Now, there was a moment when I pulled this up, and I believe we were at 7.25. I mean, it was like the morning was a 7.25, maybe Monday, Tuesday, and here we are now 6.875. So it went up and came back down immediately in the same day. Interday reprices came back down to where we're at about 7. Right now we're at 6.875% with a good credit. I mean, $400 here with the loan store, which we've talked about. They're doing a good job of staying at the front of the pack because they just acquired Home Point and they want to make sure to make a good impression on Home Point's customers. Let's take a look at where we are at if we want to get to a 5.99 or a 6.0, costing almost 2% right now to get to a 6.0 with the loan store. We always like to take a look at what's going on with United Wholesale. 5.999 is costing 1.867, so just about the same. Their par rate right now with no points at all is 6.999. You see how they're trying to offer that rate under 7.0%. But as you can see, home loan interest rates in general are pretty close to the highest they've been through this cycle. Here's our parameters here for the Brit Bruce Daily that we always take a look at. So we are really kind of bouncing up against really the highest rates have been throughout this entire cycle, at least with us, with the Brent Bruce Daily and Rancho Capital, where you're going to see right now people are offering 7.5, 7.75 because they don't have the ability to offer the rates that we offer here at Rancho Capital as a mortgage broker. So once again, if you're unaware, we are doing loans at these interest rates right now. I'm doing them today. If that's something that you're interested, make sure that you reach out to me so I can talk to you about how I can help your clients with these interest rates. Because once again, if they're very well qualified putting 25% down, the rate is not in the sevens. If you're getting a 7% offer from your mortgage broker, from your mortgage banker, from the bank that they're using, the rate is too high. That is not where the rates are today. We are still in the sixes for a well qualified client who has 25% down. We can take a look and see what we can do specifically for your client, but I don't want to hear anybody getting a 7% right now. They should not. Make sure that you let me know what is going on, how I can help out. Let me know your questions, your comments. I will get back to you as this is going to be interesting getting into the CPI, the PPI, and the announcement from the Federal Reserve. Apologize for missing a couple of days. We'll talk to you again soon.